speaking of April 2nd, Tom Lee talks about it being a clearing event for stocks, and there's a legitimate debate as to whether it will be. Of course, Goldman's Tony Pasquarello, in his latest note, isn't so sure of that, and he almost agrees with Joe in part. The quote is, the big dynamics in the game have changed, and it's not obvious to me that April 2nd will prove to be a clearing event. And he continues to say, preservation of capital is the name of the game right now.
Yeah, and that's what I've been saying for a while. Look, last week, the week before, we all came out, and I agreed with that, with saying, okay, that's going to be a buy the news event, because it's not going to be talking about the tariffs on Wednesday, because it's not going to be as bad as people think. And we referenced Brexit, we referenced the Trump election the first time around, we were so negative going into it, and then bang, it turned. This is different, and I'll tell you why this is different. It's different because those were one-off events, one instance events. Brexit, there's nothing following Brexit around. Trump being elected, that was the election day that everybody was going to. Here, it's going to be an ongoing atrophy of the market. To think that they're causing this havoc, the administration has this great plan behind the scenes, causing this havoc to drive rates down, is ludicrous. Okay, rates are coming down because people are going to hide in bonds. They're not, and it's not going down because they want to drive the housing market. They don't care about that. So I'm not saying that some of his policies aren't good.
Well, what do you mean they don't care about that? They do care about the economy. You don't think
they don't care about it near term. They don't care about it near term. And if they do, I'm giving them the benefit of the doubt. Okay, I'm saying they don't care about it near term. If I thought they were doing this before because they thought this would drive the economy, then I'd have a different attitude.
But they do. They just think that you need to go through. I'm just telling you what they've said. This is not my point of view. You need to go through the detox period so that you can come out stronger on the other side.
So let's talk about the detox period. Okay, the detox period is going to go on for a long time because there'll be ongoing uncertainty. So, yeah, we'll get to periods where the market may rally because it gets oversold from some emotional moves in the short term, like Joe says, and I believe that. And could it be Wednesday? Could it be Thursday? Sure. But on an extended basis, no. The economy is atrophying. The market will go lower. Earnings estimates will be coming down. And again, I don't care if we go into recession or not. I do care economically, but I don't care about that dialogue, that narrative. What I care about is the direction of the economy, which is definitely going lower. So, again, the policies, cutting bloat, great policy. I agree that we should. Cutting, matching tariffs. I don't know if we want to match them exactly because there are reasons why there are higher tariffs. Great. But it's like being in, to go to a sports analogy, it's like being in the offensive, coordinator going through the game plan and running a play in practice. 9 times out of 10 in practice, that play is going to be a touchdown, a pass. But when you get to a game, it's a toss-up. Is it going to be a touchdown? Is it going to be incomplete? Or is it going to be an interception? My view is, my call is, it's an interception, and that we're screwing up on the execution. It's going lower.
Shan, David Kostin cut his price target again on the S&P to 5,700 from 62. Also at Goldman, Jan Hatzius, the economist there, 35% chance of recession now. Larry Fink, in his annual letter, of course, the head of BlackRock, I hear it from nearly every client, he writes, nearly every leader, nearly every person I talk to. They're more anxious about the economy than any time in recent memory. Of course, you recall as well Rick Reeder of BlackRock telling me just the other day that it's time to hunker down, that this level of uncertainty has just put a paralysis on the business and investing and consumer community.
Yeah, clearly, Scott, there needs to be a shift in the focus. And I think the challenge is here is that, that shift in focus probably doesn't come to us until, June, July, when we really start to focus on taxes and the extension of the Tax Cut and Jobs Act. I mean, that is the second half of the year agenda item. that President Trump needs to deliver. You talked about in terms of what the administration is trying to do. And actually, I would argue a bit with Steve and on that yields point. You know, if you think about, if you listen to Treasury Secretary Bessent, what he's trying to do is he's trying to alleviate some of the pressure from the fiscal perspective. He's trying to bring down that deficit. Tariffs can do some of that, but if you look at the three main pillars of that, it's the interest expense, so therefore lower yields. It's defense, which, you know, trying to move out of some of these conflicts in which we have been, you know, quite involved. And the third thing is entitlements. And everyone knows that that's really difficult to touch coming into a midterm year in 26. And so I do think that coming back to lower yields, yes, that's going to be good for the consumer, but it's really around that interest expense and then lower oil prices. And so I think this uncertainty, Scott, the challenge is that whether April 2nd or it's April 10th or it's April 20th, what you really need to look for is you need to look for a more prescriptive approach in terms of tariffs, coupled with a more prescriptive approach in terms of what's happening in Washington on the spending side. And then most importantly, looking for some of that stimulative activity in terms of the Tax Cut and Jobs Act to come through in the second half of the year. This limbo period is going to be very challenging, but we continue to believe that the transmission of deregulation, changes in some of these departments, and some of the more pro-business aspects of the new tax cuts could, you know, create that sentiment impulse that we're looking for to drive gains in the second half of the year.
The hardest time to buy, as everybody knows, and I just say it, I don't act on it, you all do. The hardest time to buy is when it's the worst, when the pain is the most acute, when the uncertainty is arguably the greatest.
Scott?
If you think that in the long run, we're going to be better off and that we've already come down enough.
Sorry, you saw me jumping in on you there because it's a great point. It's like one of the biggest points I make with clients. This is why you don't market time. I can't say this any more clearly. Getting the exit right is easy. Walking into 2025 and saying stocks are expensive, I'm going to get out. Sorry, there was a cut in there. Okay, just getting out is easier, but getting in at a period like this, which is when usually maybe it's a, you know, buy the news on Wednesday, whatever it is, which is usually when the big days come, is hard to do. It's why I don't do it. So Scott, even though I've been talking with concern earlier in this session, you don't see me selling small caps. You don't see me selling Delta. I'm not going to try to do that because it is exactly the wrong time to be selling.
So I don't know if I agree with that.
What do you do to make the distinction between just saying, okay, we're just always going to buy the market any time it's down because it always goes up?
There's an answer.
Versus where you began the show saying, listen, I'm really concerned about what I see in front of me.
Look, I am concerned, and I'd be a fool not to be concerned. But the answer to your question is you have to be ready as an investor, not a trader. And I know you, Steve. You're an excellent trader, okay? As an investor, you have to be ready to get through a downturn. And I've been saying this again and again and again. If you bought the S&P 500, just the S&P 500 in October of 2007, probably the worst time you could think of going into the great financial crisis. And if you held it through that and came out the other side and held it through everything, peripheral debt crisis, Fukushima, COVID, you'd have a 9.5% annualized return through to the current date. I mean, look, if you want to say that by market timing you can do better, that's great. But most people who market time do worse than that.